So as Rich said, my name is Mark Dikeman. I'm the executive director with the Kansas Farm Management Association. I'm going to spend a little time talking about tax returns and how they apply, hopefully how they apply as a lender. I'll warn you, I'm an economist by training, and I have a strong interest in farm income taxes. So does anybody know what that makes me? Really boring. So I have no sense of humor. I'm monotone, and so good luck with the next hour or so. So I'll start with a little disclaimer. What I'm going to talk about is for educational purposes. I'm not going to apply anything to a specific farm income tax situation. If you have questions about that, you need to work with a trusted advisor, a local or an experienced farm income tax preparer. If you're not familiar with KFMA, with the Kansas Farm Management Association, we are part of the Ag Econ department here on campus. We have 11 offices across the state, 24 extension ag economist positions who work directly with farms in a variety of areas. Bookkeeping is kind of the foundation of all that. We spend a lot of time assisting with making sure records are accurate, up to date, and then use those records to create a very detailed accrual financial analysis for the KFMA clients or members. We work with them to put together a balance sheet at the end of the year. We can assist with enterprise analysis, income tax planning. We spend a lot of time on income tax planning, transition planning, estate planning, pretty much anything financial related for the farm we're going to assist with. We do have a sister organization that does help with the final income tax preparation as well. I've got the website here, part of Ag Manager, agmanager.info/KFMA. I'd encourage you to go there, and we do put together a lot of reports, summaries of data for KFMA members. I know one thing that is of interest, I think, to especially to lenders is summaries related to family living expense. So anybody want to guess in 23 where average family living expense was? 80? Someone said 80? Close. Right at $90,000 average family living expense. That is without income taxes, without self-employment and income taxes. That was another $33,000 on average. So looking at about $123,000 in family living plus income taxes. So kind of a shocking number how that has changed over the last number of years. So I think maybe one of the main points I want to make today is if you are using an income tax return as part of a lending decision, I want you to really consider the source, consider what's going into that. I've heard the saying that 50% of doctors graduated in the bottom half of their class, which is true. Not everybody is a good bookkeeper, I think is what I'm trying to say. And if records are not as accurate as they could be, then the income tax return is not going to be as accurate as they could be. In addition, you need to consider the effort and knowledge of the preparer. If that preparer is trying to crank out as many tax returns as possible, they're not going to put the effort into verifying and reviewing like they maybe should. And with farm income taxes, there's a lot of nuances, a lot of rules that don't apply to Main Street businesses. So if someone is not doesn't have a lot of experience in farm income taxes, there could be some things to miss. And we'll talk about a few of those today. So again, just consider the source if that is something you are using in your lending decisions. From a little bit of a bias standpoint, from my experience, I guess when we are working with farm families, we really try to avoid the idea of income tax minimization. In the long run, we have kind of a rule of thumb that we'll like to use. In the long run, non-farm net farm income plus off-farm sources of income in the long run needs to be greater than family living, income taxes, and principal payments that are going for land. Those land principal payments, never deductible. You always have to purchase land with after-tax dollars. Now, this does ignore winning the lottery and inheritance, but that's not in the long run. This really is something to consider. If someone's not, if after-tax dollars is not meeting these needs in the long run, that wealth is going to go backwards. We're going to create more debt and go backwards from a net worth situation. So now, don't get me wrong. I don't believe that we want to, or we don't encourage people to pay tax just to pay tax. I think we need to maximize those after-tax dollars rather than minimizing the income tax liability and using the tax laws to our advantage and making sure we're paying what's needed, but not a whole lot more. So I'll look at a little bit at some individual income tax forms. I'm going to look at individual a little higher level than maybe when we get to the entities and those returns. However, yesterday when we were in Garden City, the same presentation, there were quite a few questions about income averaging. So if there are questions about what we talked about, don't be afraid to interrupt, to ask questions, and we can go into much greater depth. So the two primary forms that we will use on a return to report farm income, obviously Schedule F. All farm income and expenses are going to be reported there, or farm income and expenses for an active farmer, I should say, are going to be reported there. The second form, I think, that kind of gets overlooked at times is Form 4797. And this is where we would report sales of breeding livestock, land sales, and sales of machinery and equipment. This is since 2018, since the Tax Cuts and Jobs Act, this Form 4797 has become more important because we can no longer, prior to TCJA, for tax purposes, we could treat equipment trades as a like-kind exchange. And since TCJA, we're now required to, if a tractor is traded in, for example, we have to treat that old tractor as being sold, which is going to show up on Form 4797, and then an outright purchase of a new tractor. So there's no like-kind exchange. It has dramatically changed the way that farm income is reported on individual tax returns. So again, 4797 and Schedule F, both very important from a farm reporting standpoint. Some additional forms that might be of interest, Form 4562, this is where depreciation is reported. That depreciation total from 4562 will flow into Schedule F and will be reported there, but the 4562 gives you the details of what goes into that depreciation number. We'll talk about that a little more when we get to the entities. Schedule SE is where self-employment tax calculations show up. And as a little bit of a side note, with TCJA, with the change to reporting of farm machinery and trades, we've seen a lot more negative Schedule Fs and very high, very positive Form 4797s. The result of that, from an income tax standpoint, it doesn't change things, the same overall amount of taxable income. The big difference is there is less self-employment tax paid by farmers overall. The negative to that, besides the obvious less Social Security benefits at retirement, one of the bigger problems with that is disability benefits that come along with paying into Social Security. Farming is not an occupation that is it's not a desk job. There are risks associated with that. So having some disability coverage through Social Security is can be quite important. And they're even with a negative Schedule F, no self-employed income, no self-employment tax, there is some options that we can the optional method we can use to pay in some self-employment tax. So that's kind of a separate side issue. Next form I want to mention is the 7206. This was new in 2023. Previously, the self-employed health insurance deduction was calculated using a worksheet. It's kind of hidden in the back of the return, not necessarily part of the filing. But with the 7206 now, that calculation is reported, is part of the return, can be quite important, especially considering the cost of health insurance anymore, the cost of a self-employed health insurance policy. Probably the most misunderstood form in the tax world is Schedule J, income averaging. I'll get to an example of that coming up. I think it's misunderstood by taxpayers, by tax preparers, by the IRS. Pretty much everybody involved has struggles with income averaging. It's such a little niche form that there's just not a lot of knowledge out there. The last one to kind of mention, also misunderstood, I think, is Form 8995 with TCJA. I've referred to this many times with Tax Cuts and Jobs Act that was came into being in 2018. We got this wonderful thing called qualified business income deduction. That deduction is to boil it down, could be a deduction up to 20% of farm income. Just a paper deduction shows up on the return, can be extremely beneficial to people. It is limited in a number of ways, but could be very, very important for ag producers. There's two forms related to that. This is the kind of the short form, and then the longer version that gets quite complicated. So let's take a quick look at income averaging at Schedule J, just to kind of illustrate the benefit of this, what happens with this. This is kind of an oversimplification, but if we have a high income year in 2023, we can make an election to take that higher income and add it back to the 3 previous years, add it equally to those 3 previous years. We recalculate the tax for each of those years, and we kind of determine what works best. So it's more of an optimization than just one simple answer. But it essentially, from this, as you can kind of see from this example, above the black line in each year is the 22% bracket. Below that is the 12% bracket. So in 23, we're taking this income, we're taking the gray shaded area out of 23 that's in 22%, and we're putting it back into 22 or to 2020, and it's also in the 22% bracket. So we're not making any change there. 22 in 1 year, 22% in 1 year, 22% the other. There is no savings. However, the yellow and the blue, we had excess in 2021 and 22 of that 12% bracket. So we've taken it out of the 22% bracket and we put it in 12%. So for that little sliver, we're saving 10%. So again, this is an optimization. It is an election that needs to be made on each return. I can make this each year. I can make it 1 year, not make it the next. Essentially what we're doing is adjusting the way that the income tax amount is calculated. We're not changing total taxable income for that year. We're just changing the way the tax is calculated and getting a little bit of a benefit there. So I've got a little screenshot of what this is the last little bit, line 23 of the Schedule J, just to kind of illustrate what a little bit of what goes on there. And in our simplified example here, just by making the election to utilize income averaging, we've saved about $1,400. So this is something I think that should be looked at every year, should be looked at all the time. Does this help? Does it not help? In addition, the changes in tax rates that we saw coming from Tax Cuts and Jobs Act in 2018 are scheduled to expire at the end of 2026. So in 27, we know that tax rates are going to go up unless Congress acts. And you can see from the Farm Bill how well they are, how proactive they are. So we know tax rates are going to go up. They're going to go from 12 to 15%. They're going to go from 22 to 24, 25%. We know that those increases are coming. So I think there are some planning opportunities to utilize income averaging now to kind of set ourselves up to not be hit quite as hard when 2027 gets here. This is kind of this is me being a nerd getting down in the weeds, but just a mention that that there is an opportunity there. Want to mention a few changes to Kansas for 2024. You can see the old for a married couple filing joint. Kansas did have, prior to 24, had 3 tax brackets. We had a 3.1%, 5.25%, and 5.7%. Legislature has changed those brackets. They've eliminated the low bracket, the 3.1%, and kind of adjusted the ranges. So now we have a 5.2%, 5.58%, and that goes from 0 to 46,000 of taxable income. So at first glance, it would seem like Kansas is instituting a tax increase for people by eliminating the low bracket and squeezing those brackets down. However, there have been some additional changes to the standard deduction and changes to personal exemptions for Kansas. The standard deduction wasn't changed a whole lot, increased by $240 for a married couple. However, the personal exemption prior to this change was $2,250 per person. So family of 4 times $2,250, that's your personal exemption. Now, for a couple, they get $18,320 plus $2,320 per dependent. So a family of 4, there's roughly $14,000 or increase in the personal exemption. By increasing personal exemption, we're reducing taxable income. So we've run a bunch of scenarios, did a bunch of calculations, and in most all cases, there's not going to be a change in taxable, a slight decrease maybe for taxable income for people in Kansas. I don't know that I can explain why what the need was for the change when there's not a big change in taxable income, but it has been a number of years, probably 10 years, since anything from a tax standpoint has changed, or from a bracket standpoint has changed in Kansas. So I guess maybe it was time. Another big change is that for 2024 going forward, Social Security is not going to be taxable to Kansas. Prior to 24, if your income was low enough, Social Security was excluded, but now Social Security is excluded for everybody. Another item I want to point out that I think gets missed, that can be very beneficial, applies specifically to Kansas, is referred to as the Kansas expensing deduction. This essentially, if I am not accelerating depreciation, so I'm not taking 179 and I'm not taking bonus depreciation, Kansas is calculating a net present value of a stream of depreciation deductions in the future. And they're letting you take that basically all up front. So the result is I get to take about 115% roughly of the cost of an item as depreciation for Kansas. It's not really depreciation, it flows as this expensing deduction, but it's kind of a bonus. It's a bump on top. I get to take more than my total cost of that. But I do have to make the election on an asset by asset basis to take this expensing deduction. So I think this does get missed, can be very beneficial. My example here, I think the asset was about a $76,000 purchase. So I still get to take that $76,000 of depreciation over the depreciable life, but I also get to take $11,500 in the year that it's purchased. So, so a nice little gift there that again is can be missed. Questions on the individual side of things? Everybody's still awake so far, so that's a good thing. All right, let's look a little bit at pass-through entities, at partnerships to start with, and then we'll look some at S corporations. I think if you take nothing else from today, when you are looking at a 1065 or a partnership, the front page of that tax return has line 23, ordinary business income or loss. And there's a dollar amount there. If you take nothing else away from today, that is not the overall taxable income for that entity. It is not. It does not include capital gain, which would be sale of raised cows, raised breeding livestock, or raised dairy stock. And it does not include any 179 deduction. So do not use that amount as a reference for any sort of lending decision. Part of the reason why, or the explanation that I can come up with for this, is that since we are dealing with a pass-through entity, we need to maintain character of certain types of income. So interest income at the entity level flows through to the individual as interest income. Capital gain flows through to the individual as capital gain. So we've got lots of buckets that we need to keep track of things in. And that's reflected here on, this is page 5 of the 1065. We're keeping track of all those buckets, and we start with that dollar amount that ordinary business income or loss from that first page, starts there, and then we're adding and subtracting things. In the end, if we look at, for the 23 return at least, if we look at page 6, line 1, this is the net income for that partnership or LLC. That's the place you want to look if you're interested in overall net income. On that same page, page 6, we also include a balance sheet. That balance sheet is required if gross receipts are greater than $250,000 or tax basis of assets is greater than $1 million. The gross receipts is going to trigger most farming entities, farming partnerships. If we meet those thresholds, then we are required to complete the balance sheet. And the balance sheet, to me, is an indication that I'm accounting for all the dollars in and all the dollars out. I've got good accounting records. I've got good loan balances. I've got good balances for my cash accounts. I've reported everything. I'm confident in the return. I guess I would. I'd ask you to consider looking, or if you are dealing with a client who you know meets those thresholds, that 250,000 especially, and the balance sheet is not complete, consider the source of the return. There may be some things to question. One other item to point out that is extremely confusing on an entity return is the reporting of Section 179 depreciation deductions. Form 4562, again, is where we report depreciation. And the top section, part 1 of that 4562, does show my total, the total amount that I've elected to use as far as 179 deduction. However, if I follow the math or do the math on the form going down, line 22 says add amount from line 12, line 14 through 17, 19, and 20, and whatnot, and enter that here. If you do the math, though, line 12, in this case, is 160,000. Obviously, 45,400 does not include the 160,000. So one of the more confusing points when looking at a 4562, when looking at a depreciation form for an entity, is that it does not include the Section 179 deduction. And I think the logical explanation for that is when we elect to use Section 179, there are several limits that apply. And those limits apply both for the partnership and for the individual. And the partnership doesn't have enough knowledge to know that the individual meets those requirements or not. So the partnership is going to report it, but it's not going to fully report it as an expense. Then the individual partner has to determine whether or not they can take that expense. So depreciation that's reported on Schedule F, farm income and expenses, excludes Section 179. But the amount that we talked about for page 6, line 1, that net income, does include the Section 179 expense. So just wanted to clarify why that looks funny, why that looks the way it is. I don't have a good example or a good reason why, but it just is. We talked about income averaging and the qualified business income deduction for individuals. Those two provisions do not apply for pass-through entities. So a partnership does not get to elect income averaging, and and does not calculate an amount, a qualified business income deduction. It does pass through information that is needed by the individual to get to that point, but it does not calculate either of those two items on its own. So similar situation with an S corporation, also a pass-through entity. The amount that is reported as ordinary business income on line 22 of the front page of that, it says, line 22 of the 1120S is the form that S Corps use to report income and expenses. Line 22 is not the net income. Again, we've got to flip back several pages. In this case, we're at page 4. We're looking at line 18. That is the net income for the S Corp. Similar situation with section 179. If you look at the form 4562 depreciation, the section 179 amount will show up on line 12, but it is not included in the total. It's not included on Schedule F, but it is included on that line 18, that basically the net income. Partnerships and S Corps at the Kansas level can also deduct or elect Kansas expensing deduction, that extra bump, if they are not accelerating depreciation. Same form, it's a K120EX to report that. Again, a benefit that could be overlooked. All right, I think the last little thing I want to mention is the SALT Parity Act that was instituted by Kansas legislature a couple years ago. There's not anybody from Kansas Department of Revenue in here, is there? If you are from DOR, just gonna ignore what I say. It has been the purpose of this makes a lot of sense. When we saw TCJA, there was a limit placed on the amount of state and local taxes that I can deduct as an itemized expense. That at the federal level, that limit is $10,000 for a married couple. Someone who's profitable has a pass-through entity may not be able to deduct that state tax as an itemized expense. As a result, Kansas legislature, along with many other states, has created something that we refer to as the SALT parity. So SALT is state and local taxes. What this does is allow an entity to pay the tax on behalf of a partner or shareholder. A pass-through entity can pay the tax on behalf of that partner or shareholder and treat that payment as a deductible business expense. So a payment to Kansas Department of Revenue by a partnership, for example, would reduce Schedule F income at the partnership level, which could be very beneficial. And there's not a limit on that. So that $10,000 limit does not apply anymore. This election needs to be made by the partnership annually, and payments made, estimated tax payments made. It can be a headache for as far as bookkeeping goes. But in nearly all situations, it's beneficial. Something that partnerships want to consider, a profitable partnership wants to consider. However, Kansas Department of Revenue was not at all prepared to deal with this. In many cases, they either lost track of payments or didn't apply payments to the right entity, or letters were sent saying you owe us this, and In some cases, sheriff showed up, tax warrants were issued. It was really a debacle on the Department of Revenue side. So I think that's kind of soured quite a few people from using this in the future, but it can be extremely beneficial to those profitable pass-through entities. This is the amount is reported by the partnership on Form K9, and the tax paid on behalf of the partner or shareholder is reported on that form. If they don't end up owing tax for whatever reason, then this can be refunded to them. If they owe additional tax or more tax than this, then they obviously have to pay in a little more. So, okay, so question I guess for all of you is, just from my information, is how much weight do you put into an income tax return when making a lending decision? And has that, what we've discussed today, is that got you thinking about anything, or is a tax return pretty important, or is it something you're just required to do when you collect and you check the box?
Most deals, it's 100%. Or some of the folks CPA for people to construct income statements to make it less than 80% of our deals.
Okay.
I used to be an examiner and assure you that at the end of the day, basically the OCC is going to rely on tax returns. I mean, if you can't make it work on tax return, you can get yourself out of it, but you better be very, very prepared. It's at the end of the day, that's going to be the document examiners go back to. And with full understanding is that far inferior to net worth calculation, far inferior to a accrual income statement done correctly. But that's
not always done.
Everyone used to having it. That's habit. Go back to tax return and do it. Pledge family living until it works.
Okay. Just being recorded, Rich.
Yes.
Any other comments or questions?
Yes. Let me hear. Let's use this so I can hear better.
No, Mark, I was at the Kansas State AIG seminar in August, and you were in the back, and I think we talked about you're going to get a lot of my age group starting to leave the farming agriculture, and we have no one behind us to take our land, and we're farming with our siblings or for the siblings, and it's time to get out. The question I have is mostly on capital gains, and what are you doing with your farmers that are beginning to retire? You're going to get a bunch of them because we had a bunch in ours. And so what is the rate of capital gains on federal and state of Kansas is one question. And then what are you doing with these farmers that are getting out and all of a sudden have this income, have their machinery? What are you doing with them?
So I'll start with a partial answer, I guess. From a Kansas standpoint, Kansas does not distinguish between ordinary income, self-employed income, capital gain. So Kansas doesn't care. It's just income. And it's the highest rates, that 5.58 or whatever it is now. From a federal standpoint, I don't know that I can tell you exact number off the top of my head, but the first 90,000 roughly, if you have no other income and only capital gain. And capital gain, just to clarify, capital gain is going to come from the sale of capital assets. It's not going to come, well, so if I sold land, for example, for more than what I paid for it, then I'm going to have capital gain. If I sell raised breeding livestock, I'm going to have capital gain. We never really used to worry about it, but if I sold farm equipment for more than I paid for it, then I've got a little bit of capital gain, the excess above that. Now, so the first $90,000 or so of capital gain, assuming no other income, is going to be taxed at 0%. So how many of you would like to pay taxes at 0%? That's capital gain is not a bad thing. And I hear farmers repeatedly say they want to avoid capital gain. If we can convert from ordinary income somehow to capital gain, that's what we want to do. So above that 90,000, capital gain is then taxed at 15%. And that goes up to about 500,000, 520 or something. And then above that, it's 20%. So from a bracket standpoint, capital gain is always more beneficial than ordinary income. Now, your question on what to do with someone who has is approaching retirement and they've got a couple $1 million worth of equipment that is got low basis, and they've got grain inventory they've built up, and the simple answer is we need to plan ahead for that. It's not a suddenly decide to retire and avoid all tax. You're not going to. It takes several years to plan for that. There's options. There's plenty of options to spread that tax out to help minimize that, but we're not gonna. But not if we suddenly decide that we want to exit. And the big thing that we deal with in a situation like that is you occasionally find a producer who's going to exit. They've got $2 million worth of equipment. They don't have an heir coming back, but the kid down the road wants to get in. So they're going to sell the equipment to that kid over time. And that's a big no-no. When you sell assets that are subject to depreciation recapture, it doesn't matter when you receive the cash. If you sell that, you recognize that tax all up front. So I may structure that payment to be spread out over 10 years to that kid or that individual, but I've got to recognize all the tax up front. And that's a big shock to people who don't, who aren't aware of that.
So in that case, a better strategy would be to piecemeal it?
There's alternatives to that, yes. Yes, you can piecemeal and lease out the rest. So, you know, I sell 10% of it this year and I lease 90%. And then the next year it's 80-20 and work my way down. So that's one option. That needs to be structured very well and well documented, because the difficulty in that 10-year period, that equipment's likely to turn. Not all of that $2 million is going to be around at the end of that 10-year term. So it's got to be structured very, very well. The other option is an entity of some sort. So I can sell a portion of an entity every year. I can sell 10% of it this year and another 10% next year and work my way down. But selling the equipment outright without the entity can be a big shocker for people.
Can you define entity?
So when I say entity, I'm talking about either a partnership, a general partnership, an LLC taxed as a partnership, or an S corp, an S corporation. You could use a C corporation, but there's not a lot of reasons to for those anymore. They're just rigid enough that, although I don't remember which candidate has mentioned that they would like to go to lower corporate rates, which would make us more interested in C corps than we've ever been before. So we'll see what happens.
If the Tax Cuts and Jobs Act expires and nothing's done, do capital gains rates change?
Yes, they will somewhat, and I can't tell you off the top of my head what those will be. It's not a dramatic impact, but
so but you still sell real estate over time.
Yeah. So the question was, you can still sell real estate over time. Yes, you absolutely can, and that does in that case spread when you've got capital gain and you're selling that over time. It does spread that that tax out. So that is a big difference between land and machinery.
And then one more, can you clarify on 1031 exchanges, what can be exchanged for what?
Okay,
Repeat
so the
that.
question is, what, on a 1031 exchange, what can be, what is like kind? What can be exchanged? And the simple answer is real estate for real estate. So, and real estate is it. So can't do a like kind exchange with machinery and equipment. Can't do that with breeding livestock. It's only real estate. And the definition of real estate is pretty broad. So it can be
The office building in front of it?
it could be, yes. I mean, there's some nuances in there, but yes, you can do that. And it doesn't, when you're going from depreciable property to non-depreciable property, there may be some tax consequences to that, but yeah, on the way up here, there's an apartment building on Manhattan Avenue for sale. So, you know, you could sell a piece of ground in western Kansas and buy an apartment building in Manhattan if you wanted to. I'm not suggesting that, obviously. It's like kind is pretty broad when it comes to real estate, which is funny because before a dairy cow was not like kind with a breeding cow, but a building in New York City is like kind with farm ground in Western Kansas. So go figure.